Hi, my name is Liz Day. I am here to talk to you about a refrigerator company that had an issue recently, and we're going to help explain why. So Parsi is in charge of buying and raw material at a refrigerator company, and in that he is also responsible for forecasting what the cost of materials is going to be, along with how much he needs to buy for those for the refrigerators for the engineering department to be able to make the refrigerators he needs to make. The engineering department didn't have enough raw materials when they went to make the refrigerators for this last forecasted period. So the forecasting that Parsi did for the quarter was way off. So we're going to figure out why that happened. And due to that forecasting being off, it led to adjustments needing to be made for accounting. So Percy's having a hard time understanding why it's a big deal for the accounting department and for understanding for the future how to make those adjustments to not have this problem happen again. So we're going to talk about journal entries. Journal entries are how, like, the accounting department will keep track of transactions. With every transaction in accounting, there needs to be a debit and credit. And so here's an example of what a journal entry may look like. So you're going to see the date, the account, and then a debit and credit columns. The date on this example is January 31st. Debited account, so this will be a title of an account, so maybe it's cash or something like that, but this is going to be the first one is always listed as your debited account, and then the amount that is going to be debited is going to be in that first column under debit, where represented by the X in that. And then there's going to be an account that is going to be credited, which is the second account, which is indented, and that's going to be the credited account and where the money is coming from, or the opposite account, so they should match. And then you're going to have underneath that a description of that transaction, just so people know what that transaction was for, and just to give a little more insight. So that's the first thing that's going to regarding Percy and understanding accounting. And then from that, then there's T accounts. So to help keep track of understanding debits and credits, they make it a little more simpler, and they try to do it visually in a T account. So you'll see here, and this cost of raw materials is going to have a T account, which is going to look similar to this. And then you're going to see on the left is going to be your debit column, which is right here. And then you're going to see over here, there's an inventory column that's going to be your credit, represented in Y on the left or on the right-hand side. And then you can have multiple T accounts for different items and different expenses and different accounts within your accounting and journal entries. Then you'll have a summary that's going to be a sum of debits and sum of credits. Then usually those things should match up. If they don't, then that's your signal that there needs to be something adjusted. And then that will lead to our adjusting entries. Adjusting entries is when something doesn't seem to add up, and we got to account for that because something maybe was unexpected or didn't plan the way that we planned on it, and we're going to account for when it actually happened. So in this scenario, Percy was over his budget about $350,000. So in this adjusting entry, you'll see the date, account, and debit and credit columns here. And the same thing, very similar to the other journal entry, you're going to see the first one being your date column, your cost of raw materials is the count, and that's debited $350,000. And then the inventory column is the credited account. Underneath there, indented with $350,000, and the description underneath it to account for the incorrect estimation of materials. So how do we make sure that we do a better job in the future and we don't come under that? So suggestions for the future: evaluate the current cost of materials. Make sure that what we're paying today is really what the right cost should be. Should we be negotiating that again, or anything like that? So we need to be talking to the buyers and also our vendors that we're getting the material from. We're meeting with the engineers to discuss how much material needs to be in each refrigerator. Are we using the right amount? Do we understand what that looks like? So we can make sure that we're accounting for that in our forecast. And take the information that we learned and use it in the future forecast. And the last one, review the forecast each month and make sure the adjustments for the next month are accurate. So we're not waiting till the end of the quarter or a longer period of time to realize that we are too far gone or missed our mark by too much. I hope this helps Parsi and understanding in a simple way to make his organization run more smoothly and have a better job of taking into account finances. Thank you.